Hi there. Thank you so much for joining us today. As you're coming in the webinar room, I want to welcome you. My name is Marcia Butler. I'm the webinar director here at Advice Chaser. Before we introduce our guest and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. And I'm going to go ahead and turn that feature on right now. Excellent. The presenter will answer those queries after the webinar presentation today during our question and answer session. And if you have ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information as well, and we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our presenter today. Eric McMahon has always had an entrepreneurial drive and spirit. At 10 years old, he started his first business and continued it through his college career. Before starting his career as a financial planner, Eric received his undergraduate in accounting and master's in personal financial planning at the #1 financial planning program in the nation at Texas Tech University. Eric has over 10 years of experience and has worked with hundreds of individuals to help them achieve financial efficiency. Eric has been with Integrity Financial Group for over 5 years. His areas of focus include retirement income planning, estate planning, and business planning. Eric holds a designation of Certified Financial Planning Practitioner. Eric enjoys working as a team to help people build their financial futures. And personally, Eric enjoys following his alma mater. He led his local alumni chapter for many years and helped raise over $30,000 for scholarships for local students. He also enjoys traveling, the outdoors, and climbing various mountains. And I know we're going to get into using mountains as one of our examples, so I'm excited to hear that. I'm going to go ahead and turn over the time to you, Eric.
Thank you, Marcia. As Marcia mentioned, I'm Eric, and before we dive into the content that we are going to be covering today, I did want to warn everybody, I've had a stutter for many years of my life. So there are some words that I still get caught on, but I try and tell everybody it's very similar to if you're on an airplane with turbulence. It may be a little bumpy, but I do promise we are going to get to where we're going. So a little bit about today is our topic, as Marcia mentioned, is how much money should I be putting in the market? But before we can actually tackle that, we have to first start with a foundation of what is the underlying premise for all long-term savings that anybody does. So we ask our clients as a whole is, why are we giving up our current enjoyment of your income versus spending it and enjoying it now? And the answer that a lot of people give us is not always the correct one, I would say, is that a lot of people say, I need to save up my money and have this big bag and have this Scrooge McDuckie and vault available to us to where then I will be okay. But the real answer is we save and we save so that we can have an income stream to replace what we have during our working years. So if that's the answer we have, then we have to start with, it only makes sense to understand how retirement income streams work so that we can direct our current savings today in ways that give us the highest income when we retire. So said another way, retirement income streams work different economically, and we need to define those so that we can allocate our savings properly today. Not only that, but the sooner that we are on an efficient path, the greater the impact we'll have on our retirement income streams. So as Marche mentioned, we are going to talk a little bit today about mountains. And so when we meet with clients, we always ask them, what is the objective? If I were to ask you, what is the goal when climbing a mountain? And many people say to get to the top. And while this is true, it's also important that we understand the real goal is not only to get to the top, but to get back down. And from someone who climbed a mountain a little bit out of his range last year and almost didn't make it back down, I can tell you it's really important to have that goal in mind. And when it comes to retirement, we have the accumulation side, and stocks and bonds, mutual funds, all those things are great for the accumulation side, but the distribution side is quite a bit different than on the accumulation side. So when we look at this and we approach our planning that way, that's where we begin the need to understand how retirement income streams work, because they'll define how we pack our bag pre-retirement. Because we need to have, if we have the understanding that, is it possible that the tools that we need coming down could be different than the tools that we need going to the top of the mountain? If the answer to that is yes, then we need to ask ourselves, when do we pack our bag, and how do we pack our bag? And from somebody who's been to the peak of many mountains, I'll tell you, there's no REI shop at the top of them. So if there's no REI at the top of them, or there's no changing, when is the best time that we need to start planning efficiently? It's before we go. And so what we need to focus on then is have a focus on, we need to begin with the end in mind. And so when we look at that, and when we ask ourselves that, then we look at the problem. And the problem is how retirement assets react to fluctuating returns when money is being withdrawn for income. So if we look at an example, if we take 1970 through 1999, these were the 30 best years of the S&P. They had a mean average here of 14.84%. Most would say if you can get an average of 14.84% per year, that's pretty good. But the question is, what happens when we are in retirement? If you retired in 1970 with $1 million and you said, I need to replace my lifestyle of $100,000. Well, over a 30-year period, if you got that average of 14.84%, you're not only going to be very happy because you were able to live off of $100,000 per year, you're going to, at the end of 30 years, you're going to have a nest egg of $15.1 million. And so the reality is not only are you're going to be happy, you're probably going to be throwing parties and buying lunches for anybody that helps you get to this point. Unfortunately, that's not actually how functionally the market works. Many people always throw out averages, but as soon as you start coming down the mountain, or you start having the mindset of, I need to understand how I'm going to create income, we look at what the market actually did. In 1970, we had a return of 3.99. In 1971, we had 14.33. 1972, 18.94. Most people would say that's a great start to retirement. The problem is 1973 and 1974 both combined for a negative 40% decrease in the market. Imagine being in retirement, trying to maintain your standard of living and seeing that happen. Well, I'll tell you, you don't have to imagine that, because I'm going to show you right here what actually happens. Is that if you look at what the market actually did, we still start off with our $1 million. Through those 30 years, there's still the average of 14.84%. But instead of making it 30 years, you only make it through halfway through 14. So once we understand now that while the market is a great accumulation tool, is that if we still focus, if we put all our eggs in the basket, we're not only going to be able to maintain our standard of living, but after 5 years, you got half of what you started with. So this is why you saw people who retired in 06, 07, 08, many of them had to go back to work. If you look at people who retired even at the end of the 90s, you had the dot-com bust, and many of them had to go back to work. And that's because they didn't begin with the end in mind. They loaded up their 401ks, they loaded up their IRAs, and they said, the market long-term is the answer. And while on the accumulation side, they're absolutely correct, the problem is people limited themselves because they didn't diversify and plan in an efficient manner for when they actually did retire. What happens many times is there's many people out there who say they're financial advisors, and what they do is they say, great, if you look at your 401k projections, if you look at IRA projections, or even if you look at just simple mutual funds, stocks, bonds projections, things along those lines, is they'll say, great, you have 35 years to retirement. We're going to project an average rate of return here of 6%. If you save $6,000 into your IRA, then you're going to end up with a future value of $708,000. Mr. or Mrs. Client, doesn't that sound great? Of course, people are going to say, wow, if I save $6,000 per year, I'll have $708,000 in 35 years. Most people would take that. But if I were to ask you, would you rather have $70,000 per year or $1 million? What would you say? And most people would take the income. And if we go back, because this 708,000 number sounds great, it shows, wait, I'm only going to put in 210,000 over the years and end up with 708. The problem is that we go back to this chart here, that it sounds great to have that big bag of money. It sounds great to have that $708,000. The problem is that we know as soon as we start taking money out, any sort of negative years are going to hurt significantly more than gains help. And so when we go back to this future value, it's great to have this. It's good to have an understanding that I could have this bag of money, but you've got another 20 or 30 years of retirement that there's no real plan for at this time. So we go back to how significant is efficiency when it comes to planning for retirement, when it comes to planning for the end in mind, is that an individual may be able to create $75,000 a year in income by just pouring all of their money into the market, and based on current savings with an efficient process. But is it possible for the same individual to create $125,000 a year of income with a more efficient process, potentially diversified between different asset classes and between different financial tools? The answer is yes, but it also depends on each individual client's specific situation. So when we look at that, people may say, well, Eric, how is that possible? how is it possible then to go from 75 to 125, not saving any more dollars? Well, the answer is does this person qualify for private equity? There are situations that people are saving and saving and saving, and they're loading up their 401k, or they're dumping money into their brokerage account. But that's just the same thing over and over again. And you ride that stock market roller coaster. Well, do you qualify to invest in private equity? Additionally, there's real estate. And so what many people think is, hey, if I'm going to invest in real estate, I have to go buy a rental property. I have to go buy my own piece of land. I have to do that. I have to buy my own commercial building. Well, the reality is you don't necessarily have to do that. There's ways to invest in real estate on an individual level that you're not taking on the entire risk. Real estate can produce income. It can produce a hedge against inflation. There's many uses that individuals can do on a smaller level. Insurance. There are certain insurance vehicles that provide downside protection with upside potential that can actually help with people's portfolios, make them not only give them the ability to be more aggressive in other areas, but it lowers the risk of their overall financial portfolio. Buffered investments. As many more people start to retire, investment companies have actually diversified. There are investments out there that provide people with certain downside buffers. An example is 15%, but still give people the ability to have an upside potential. And so this, again, helps people lower that risk, but still gives them the possibility of upside returns. And then you have things like alternatives. These could be baskets or buckets of commodities, futures. And it's just one of those where there's so many different options out there that many people don't know, because they've heard for so long, load up my 401k, load up my 401k. And we have found that walking through with clients that let's make a specific plan for you, that some of these areas may make sense. Some may not, but but by diversifying, you're able to create a more diverse, efficient vehicle. And so we have found that when we walk through with clients, it's important to understand this protection piece first. So we want to make sure that, so many people think I'm going to work and work and work till retirement, and then I'm going to stop working. What happens if you're no longer able to go to work? Then we have the question of, well, are you still going to be able to pay the mortgage? Are you still going to be able to save for retirement? So it's important to understand that, yes, we can, you can dump money in the market, but what happens if you're no longer able to work? What happens if you're no longer able to come home anymore? After we have established that protection piece, we have found that clients love talking about savings. Well, when it comes to savings, we have to look at both short-term and long-term, because again, while it is nice to focus on the now, if we focus with the end in mind, we really then begin to break down this long-term savings here. Where is the most efficient place for you to save your money, not only for the short term, but also for the long term? Let's take an example of how we have worked with some clients to show the impact of diversifying in other areas. We've got Jim who's 30. Jim wants to retire when he's 65. So that's in 35 years. Currently, Jim has an income of $125,000 in income. Over the past few years, Jim has saved up $73,000 in assets. He's currently saving 17.5% of his income into the market. He's just loading up his 401k. He's growing it. And he's being matched 3% of that by his company. And as I mentioned, he wants to retire in 35 years. If Jim were to save $0 more, if Jim just stopped saving and did nothing else, we can show him here in this gray bar is the assets he has already accumulated at 65 should be able to produce somewhere around $27,000 per year. That's great. We can sit down with Jim and say, Jim, you save no more dollars. You're on path to recreate $28,000 of income. That's good. You've already done a diligent job. If you continue to save in this salmon bucket here, if you just keep saving every bit of the dollars that you have into the market, then you're going to be able to create around $156,000 per year. That's also to be commended because you would then have been diligent about saving those dollars over 35 years. But what if you were to save in a more diversified way and you were able to have more options at retirement? To this date, I have not found anybody that did not want more options at retirement. And so what we were able to show Jim here is if you diversify between different tools and different asset classes, that Jim would be able to create around $239,000 per year or 257. And that really comes down to, does Jim want a more guaranteed approach to it, or kind of a own personal pension? Or is Jim okay accepting some more risk, but having some volatility buffers for those down years? And that really comes down to just giving Jim more options. Let's take a different approach because Jim is 35 years to retirement. Let's take Jack and Jill, and they've got about 15 years to retirement. Jack loves working, so does Jill. They have currently they have $230,000 in income combined between the two of them. They've accumulated assets over the years of $1.1 million. Currently, they're saving 25% of their income into the market because they're loading up their 401ks. The kids are out of the house and they say, you know, we have this flexible income. Let's load up our 401ks. Let's load up our IRAs and let's just keep saving into the market. They're currently being matched 6% of that. And they ask me, they say, Eric, what path am I on if we retire in 15 years? Well, if we look at their scenario, we can say with the amount that you guys have saved, if you don't save another dollar, if from now until year 15, you don't save any more, you can still create somewhere around $93,000. That's good. You have saved up to this point. You've been diligent about it. We still have an income if you didn't save another dime. If you guys continued in this salmon box here to save all of your money into the market, we can help you create $155,000. That's good as well. You guys have been great savers. You guys are continuing to save. That's great. But if you diversify within the tools available to you, it's possible for you to create $229,000 a year with much of it being guaranteed, or you can still maintain some risk and create $276,000 per year with 4 years of buffer in the event there's downsides in the market. And these numbers here, they seem very different, but you wouldn't actually be saving any additional dollars. You would just be diversifying where your money is being saved. So to transition a little bit is, the question is, how much should I be saving in the market? And there's so many financial advisors out there right now. You can go to a bank and somebody can call themselves a financial advisor. There's a large contingent of the insurance world that people call themselves financial advisors. There are those that only deal with investments, with stocks, bonds, mutual funds. There's people in the real estate industry that call themselves financial advisors. They're not right, they're not wrong, but it's just many times those individuals can only give advice or only offer products and services either specifically to the company that they work with, or their industry. And many times these four pillars, they don't even communicate with each other, and that's unfortunate to you, the consumer. And then additionally, we all love working with somebody that we know and trust, but how much experience do they have? Do they just have experience in their wheelhouse? Do they have experience in multiple different areas? These are all important questions to ask. Do they have the ability to access a huge variety of assets and solutions? Do they have ability to offer things that maybe that you've heard about somewhere, but they can't because they're in a specific industry or company? And then lastly, are they an individual, or is there a team offering tailored specific solutions to your situation? Again, none of these things are right. None of them are wrong. It's just what fully can the person calling themselves a financial advisor do for you? And so if we look at the big picture, I've been in the industry now for over 10 years. I've worked on the mainly insurance side. I've worked on the mainly investment side. And now I'm in a place that embraces both worlds. But what I would just encourage everybody is to, one, find somebody that can help you approach financial planning from a standpoint of focusing on the end in mind. What is the long-term plan? Not only short-term, but what projection am I on? Not only 30 years, but 60 years from now. What does my income look like in retirement? I would also encourage people to find somebody that will help you specifically, to focus on you, not just, hey, these are, specific investment tool that we've been seeing work a lot recently, but for you, the individual, to find somebody that will focus and make a specialized plan for you. So that's all that I have today. I'm going to hand it back over to Marche.
All right. Well, folks, this is time for you to ask some questions. We already had some questions in, and I wanted to get started with those. But if you have a question that comes up, go ahead and put that in the chat. I'm actually, for this question, I'm going to go back to your slide here about this mountain, the accumulation and distribution. The question was, at what point do you need to diversify? If when is like the best time, and when is it too late? Talk to us about timing for your life there.
Great question. So one thing I did not note in the presentation that we normally walk through with people is, if you were going to hike up a mountain per se, one that you don't have experience with, would you potentially train with somebody, or even bring along somebody like a Sherpa to help you? And we would say yes. So when you look at this slide here, when is the best time? The answer to that question is, well, how many options do you want to have? Because I would say the earlier that you diversify, the better, because you're just going to be able to have more options at retirement. If you get to the very top of this mountain, if you don't diversify at all, then you're at the peak of the mountain there. Well, we only have so many options available, and that answer is down. So we only have so many presented in front of us, where you have, we certainly would have options available to us, but the earlier that you start to diversify where you're saving your money, the better position you're likely to be in. So for each person, it's different. If we talk to a client who's, let's say, 40 years old, there's no ability to, how do I put it? There's nothing we can do before that point in time. So if you're somebody who's 65 and you want to retire at 70, again, there's only so much we can do, but we can look at your specific case at that point and say, great, I'm so glad that you wanted to ask this question now. Let's look at what options we have. The earlier, the better.
All right. Well, I must have opened the floodgates because we got like 10, 15 questions in here. I'll try to cover as many as we can. All right. So if your 401k is through an employer, can you still get help from a financial advisor for controlling it? Can you talk about that?
The short answer is, if somebody is not an advisor on the plan, they cannot give them specific advice on that. With that being said, some firms who are able to have relationships, or this is a very complicated, not really complicated way. So I'm trying to have a clear answer. The rule of thumb is normally no, but some 401ks offer options for a self-directed portion of that. If somebody, I know as an RIA, we have the ability to potentially work in there. So if there are advisors or somebody that would like to look at that, it really just depends on the individual. It really depends on the 401k plan. I'll share from my experience. We actually are able to help manage some people's 401ks, but we have to be more generalized in other ones. It really just depends on the plan, and it really depends on the person.
All right. Well, thank you. I didn't know that answer, so that's really good to know that. All right. Here's a good question. Are REITs a good substitute for owning rentals?
I feel like everybody is going to hear this from me a lot. It really just depends on the person and their situation. What I would share is that is a very broad question, because you have REITs that are based on accumulation with higher risk. You have REITs that have less risk, but pay out a specific income stream. So if somebody comes to me at a certain income level, it may not make sense for one or the other. On top of it, I would actually challenge that individual. Depending on their income stream, there's potential then to even participate in other real estate offerings outside of REITs. So again, you're probably going to hear me say this a lot, but it really just depends on the individual and their overall portfolio.
And it goes to another question, and I'm going to pull up another slide here. I'm assuming this is one of the examples of a REIT. It's one of the examples within the real estate bucket. Here are the different types of diverse places you can invest in. So this particular person said, can you expand on what each of these are? So maybe you can give an example of some of these types of categories. They wanted a little more explanation here.
Sure. There's I don't want to take it. There's each one of these can have many explanations, and while I have been known at times to potentially be long-winded, this is an area that could take significant amount of time. Private equity is available to certain types of investors. With that being said, these are private deals that it could be in commercial real estate. It could be for a business. It really just depends. And whether it makes sense in somebody's portfolio just depends on their financial situation. But with this private equity, it gives people the ability to participate in a larger deal at a much smaller share. This helps spread out the risk, but also still have the potential for some gains there. As far as real estate, this bleeds over into the private equity range, but as I mentioned before, there's numerous different types of REITs. There's ways to invest in real hard assets. Again, it really just comes down to the potential for somebody's risk tolerance and their overall financial situation. As far as insurance goes, There's vehicles out there that provide anything from guaranteed income for somebody's entire life, to downside protection with gain, with a potential tax-free death benefit. So for I'll just share, only about 2 or 3% of the population has access to a pension anymore. But with this insurance piece, that's actually how companies offer pensions that still do. So we have found that in this insurance realm is people at times, we have found we can help them create their own personal pension so that when they retire, they can say, I know I have a guaranteed chunk of money coming in, and then anything above that is just icing on the cake. As far as buffered investments, there are investment companies out there that have said people want to have a upside potential but downside protection. There's a group that we work with that one of their most popular ones is the S&P. They've got downside protection of 15%, and each month they issue new caps. I believe for April, with a 15% buffer over the year, you can have an upside potential with a cap of about 16%. So what we have found is that, so what that means is, if the market goes down 15%, your account would actually stay level, minus any fees there with the investment company. But if the market goes up 20%, you would still participate in 16. So there's more companies offering these kind of diverse strategies. There are some that have even implemented income versions of that. But again, it really just depends on how close is somebody to retirement, how much risk appetite do they have. It really depends. As far as alternatives go, this is one where it's really hard to give too much of an in-depth example, because alternatives are used depending on the climate. I'll share in 2022, and again, it really just depends what any financial advisor has to offer. I know for us, alternatives actually had a positive return in 2022 while the market was down significantly. So what we found is a lot of times alternatives can be used as an airbag inside of portfolios for any sort of landing. So many of what we found our portfolios, they were able to help buffer those declines in the market last year. So that's really a surface view of all of these, and it just really depends on each person and their situation and what their overall plans are.
Well, if we have any more questions about that, go ahead and put that in the chat. I know there were several people who were acting about this. Oh, someone said great information. Thank you. Thank you for that comment. All right. So we had another question about protection. You maybe referred to perhaps becoming disabled or passing away. Can you talk about a little bit about what vehicles are used in protection?
Again, that comes back to, it all depends on everyone's situation there. But as far as the overall protection piece goes, there's many things that people don't think about. People are significantly more likely to become disabled before they're 65 than pass away. And so what that means is that, let's say that you're no longer able to do your job. We have found that is that you're not able to go to work anymore, where, well, your income potentially stops. What is your answer to that? Do you draw down your retirement assets? Do you draw down from your savings? Or do you share that risk with somebody else, a company who specializes in that? There's many that we have found it's possible to work with as far as disability insurance goes. And so what that looks like is, I'll just share, some people say, well, I'm just going to rely on the government for disability. We spoke to somebody in the actual Social Security department, and the general rule of thumb is always to decline somebody their first time. And this is not an exaggeration, We spoke to somebody who lost a limb and they were declined for Social Security through the government their first time around. It took them 3 applications for them to actually get disability payments from the government. So when it comes to that, you have disability insurance, short-term, long-term, whichever route you want to go. There's many in-depth analysis on that, is which company to use. Is one better for your job class than the other? We have found it's helpful to look into many different options depending on our client's income and their occupation. As far as not being able to come home at all, is your family adequately protected? And we look at that is that, let's say that we have a single income household. Is the spouse, are the children protected? If that income stops, is there enough protection there that they can continue to live either the same lifestyle or a similar one? I'll share that. And then one that many people do not discuss, but is becoming a larger issue, is long-term care. Well, what is your plan? At the end of the day, there's only 4 ways really to tackle long-term care. Either the government's going to take care of me, but what most people don't know is if that's your plan, you actually have to spend down your money considerably to the point where you actually have to qualify for Medicaid. Is, oh, I'm going to have family take care of me. Well, my question to all those people is, does your family know that? Have you had that discussion with them, or are you just relying on them? The third option is you can self-fund. While that's possible, and again, it just depends on everyone's income, their savings. Are they going to be able to create that? Is self-funding a feasible option? Or 4, is it possible to work with a long-term care insurance carrier, to where I'll just use a hypothetical here, is that may cost $4,000 per year, let's just say. But what if the benefit is then, if you ever need long-term care, that's going to provide you with a $2,000 to $3,000 per month benefit. And again, I don't know, it all depends on the person, their health. But what we have found is that many people also want to stay in their homes. Well, if you go into Medicaid, or you rely on the government, they don't pay for in-home care. You're going to have to be confined to a specific nursing home facility. So that's a bit of an explanation of an overview of, with disability, that comes more into play for somebody in their potentially 30s and 40s that has a way to go to retirement. For somebody who's in their 50s and 60s, long-term care is probably more of a concern for them, because they're closer to potentially needing that. And then as far as coverage of if you're not able to come home, that just comes down to your legacy goals. Do you want to protect your family? Do you want to pass on a benefit or estate to your children, grandchildren, whomever else? That really just comes down to each person's situation.
All right, trying to find my mute button, unmute myself. So I think that's about all the time we have for questions today. We did get another question in. Is this being recorded? Yes, it is. And in fact, we will be sending out a link to the replay of this event. And you're welcome to share that with your friends and family. Give it a couple days. And if you can't if you don't see that email, sometimes email systems don't accept those. Just go ahead and go to advicechaser.com, and we've got all of our recorded webinars under the webinar tab. Well, Eric, I want to thank you. We definitely covered a lot of ground here today, and that was really informative and fun. I hope people had a good time learning about this. There's always more to learn, and we really appreciate you being here. I want to thank the organizations that also made this webinar possible today. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we match them with. So find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, folks, we have come to the end of our time. We hope you have a really great rest of your day, and we hope to see you at another webinar soon. Goodbye, everyone.